In the very near future, we're going to be placing tariffs on foreign production of computer chips, semiconductors, and pharmaceuticals to return production of these essential goods to the United States of America.
All right, so you may have heard this term tariff floating around and how it's going to replace the U.S. income tax. How is that going to impact the U.S. revenue and your actual pocketbook as a business owner? So if you buy and sell goods outside of the United States, a tariff is essentially a surcharge or a sales tax on that good for bringing it into the United States. So if you have a $100 product and there is a 10% tariff, then that's going to cost you effectively $110 to bring in to the United States to then resell to your customers. If that tariff goes from $10 or 10% to 25%, now instead of it costing you $110, it costs you $125. But that is increased revenue that goes to the United States. So essentially, what will happen is you as a business owner, or if you're not a business owner watching this, the businesses you're buying from, will pass on that cost to the consumer, to the client. On the flip side, where the idea would come from is because we're getting more of that revenue from external sources, then we don't have to rely on as much revenue from internal sources, aka income tax. And so while cost of goods will go up, the theory is your net paycheck take home will also go up to offset that, and it will force and encourage manufacturing to come back to the United States where there would be no tariffs. So if you manufacture all of your goods in the United States, you don't have to worry about tariffs. If you manufacture all of your goods outside of the United States, then they could significantly impact your business.